All right. Can still see folks kind of making their way in, but we'll go ahead and get started. Wanted to welcome everyone to today's webinar, Optimizing Collections in 2024, where we will be diving into the dynamics of modern collection strategies amid evolving economic conditions. My name is Matt Tepper. I am Vice President of Global Marketing here at GDS Link, and I will be today's moderator. Today, I am proud to be joined by Javier Alvarado, Director of Financial Services at TransUnion, who brings over a decade of experience in enhancing customer engagement across various sectors like finance and retail. At TU, Javier has been instrumental in advancing solutions that maximize outreach effectiveness and improve contact strategies, such as the innovative caller name optimization and branded call display, which we'll get into later today. Welcome, Javier.
Hello, Matt. Hello, Rich. Pleasure to be with you.
Also joining us today is Rich Alterman, who I'm sure a lot of you are familiar with. Rich, the host of GDS Link's podcast, The Lending Link, currently reaches audiences in over 70 countries and is available on major platforms like Spotify and Apple Podcasts. Rich brings an extensive background in credit risk management and collections with decades of experience that have seen him lead initiatives at companies like GDS Link and beyond. Welcome, Rich.
Hey, good afternoon, good morning.
Just to kind of go over a couple of things before we really kind of dive into today's conversation. Obviously, we'll explore how current economic fluctuations are reshaping the landscape of debt collection, highlight some innovative strategies in play, and discuss the regulatory environment impacting these processes, as well as dedicate some time to hear from you at the end of today's session. You're welcome to submit questions in the chat portion of your Zoom user interface or via the Q&A button. In the interest of time, we will be waiting until the Q&A portion of today's session to address these questions. I guess to go ahead and get kicked off here, kind of pertaining to around the current consumer trends, debt payment hierarchies. Javier, given the considerable volatility in the current economic landscape, it's crucial that we understand its impact on collection strategies. Maybe could you kick off today's discussion by sharing how these economic fluctuations are influencing, maybe kind of give us a current state of affairs?
Absolutely. Thank you, Matt. Thank you, Rich, and to GDS Link for having me. Always a pleasure to be with you all, and thanks to the attendees for taking time out of their busy day to join us. So certainly, over the last 2 years, we have seen the levels of delinquencies, increasing across all products. Yes, as you can see here, across auto, bank card, home equity, and loan products, mortgages, private label, and personal loans. The only category that has seen a slight decrease are student loans. But looking at our recent Q1 data, you can see that year-over-year growth, particularly in bank card at 11%. Is just tremendous growth. And we've seen that the overall card balances for bank card have surpassed the 1 trillion mark. So consumers continue to spend to meet their needs. And so we'll continue to monitor that. But yeah, healthy growth across all products year over year. As we look at the balance growth across products, we know by looking at our consumer credit database here in the U.S. that the average minimum payments due per consumer has also increased. You see on this slide here at the far right of every risk tier, from subprime all the way to the left to super prime all the way to the right. For the last 6 years, the most recent quarter has surpassed all quarters for the last 6 years. So in particular, you can see that near prime and prime are the two top highest spend categories and highest minimum payments. So balances are accumulating, and then that leads to higher minimum payments. We know that consumers during the pandemic chose to deleverage if they received any stimulus assistance, or if they were able to increase their savings rate. They use those funds to deleverage and pay down some balances. But post-pandemic, we can see that balances are continuing to increase. And because of inflation, consumers are paying more for their goods and services. And then that leads to just, when they choose to use credit facilities, their average minimum payments are also increasing. Now, part of those, or a good amount of those accounts are going to be in delinquency status as consumers run out of cash, as they build higher balances, as they make different choices about how to pay down their outstanding balances. As you can see here on the very bottom, the yellow line, mortgages. Although there's been a steady decrease in serious delinquency rates for mortgage over the last 6-7 years, you can see that in the last couple of quarters it is starting to trend upward, as consumers feel the pinch of higher interest rates, which leads to higher mortgage rates. And then above that, auto. Even though you see here in the last maybe quarter or 2 quarters a slight decrease in serious delinquency rates, consumers are feeling the pinch of higher payments over the last 4 or 5 years. We're seeing an increase in repossessions. So unfortunately, we think that is going to continue, for the next year or so. And then bank card and personal loans, we're seeing a little bit of a decrease there, mostly because lenders have pumped the brakes on originations. So then it just becomes a math problem. With fewer originations, then you'll have fewer delinquencies. But those we saw the bottom, if you will, around the second quarter of 2021, as depicted in this slide. But ever since then, we've seen rises in delinquency rates, serious delinquency rates over the last couple of years, then a little bit of stability, and then the last couple of quarters, in particular for mortgage and auto, we've seen slight increases. So we'll keep monitoring this every quarter and report out on a quarterly basis. And then as delinquencies continue to rise, charge-off volumes continue to rise as well. The black line here signifies charge-off volumes. So last quarter, for example, we saw over 8 million accounts charge off, and equating to a balance of just north of $32 billion. Now contrast that to the bottom there, third quarter of 2021, fourth quarter of 2021, where we saw about $10 billion in those quarters being charged off. So now, we're looking at 3x the charge-off balances. So it's a serious problem. Many of our customers in financial services are very concerned about rising delinquencies, rising charge-offs, and the only silver lining that we can see is the low unemployment rates. So as long as unemployment remains steady, I think this will not get worse, but we'll have to just wait and see.
Thank you for that, Javier. And Rich, with your 4 decades of experience, you've witnessed various economic cycles and their impact on credit management. Looking at this recent surge in delinquencies and charge-offs as shown in this slide, could you share some historical strategies that have been effective, discuss how these might be adapted, maybe re-envisioned to help manage these current and emerging risks?
Yeah, I don't want to steal the thunder of the rest of the presentation, but certainly the use of analytics to be more effective in accounts that you should be working internally versus accounts that you may decide you should potentially accelerate and place them with third-party collection agencies as an early out strategy. Certainly, I think we're going to probably see a lot more debt sales going on again in the market, and it'll be interesting to see how those prices shake out. But as we'll be talking in a few minutes, the use of analytics to really help better segment your portfolio and really optimize the use of your staff to really look at those accounts that you have the greatest probability of collecting in-house but recognizing that for certain accounts, it just may make sense to kind of push those accounts out early. One of the things that I did want to ask Javier, and one of the things going back to a prior chart, the term I'm seeing in the market right now, they call it phantom debt, and they're referring to buy now, pay later. As we've talked about in a prior podcast with TransUnion about buy now, pay later, there was certainly movement for the credit bureaus to start collecting that information. It's been a very slow and, as I understand it, painful process to make that happen. So when you think about that phantom debt, as they're referring to it now, i.e. buy now, pay later, we're kind of, not seeing the whole picture here, right? And that's a concern too, that I think a lot of lenders need to recognize, that this debt from buy now, pay later is not showing up yet. And also, I think the dip that you showed in the student loan seemed to correlate to where the change to start requiring payments again in October of 2023, but reporting is not taking place for 12 months.
Right.
So it's very possible that when that reporting comes out in October of 2024, we might see a very, very significant spike in delinquencies, especially when statistics showed that, and surveys showed that a lot of consumers said that once that student loan payment was required, I think something like 30% said they are going to have to make different choices now that they're paying that loan back.
Wow.
I think the average is about $350 a month. And I think 26% said they will not be able to pay it back. Right. So I think there's a lot of hidden headwinds that are coming our way that are going to change the way these pictures may look. What do you think, Javier?
Absolutely. You're absolutely right, Rich. Working backwards. So our internal analysis shows that, about 40% of student loan borrowers have chosen to make a payment as required. The rest are making other choices, delaying their return to paying those student loans down. And so, knowing that information, many of our customers are in a wait and see attitude, are taking a wait and see attitude, because it may significantly impact how those millions of borrowers react to that payment crunch. When you're that age and you're starting out post graduation, and you need to secure housing, maybe get an auto loan, start using more credit cards, you can rack up some serious payments every month. And on top of that, add your student loan payment. It can have significant consequences to your payment hierarchy choices. So you nailed it you nailed it when you said that reporting won't start until early next year. So we don't know, but we're ready to receive the information as soon as it starts to be reported again, and then we'll see how that impacts the solutions that we offer and the insights that we can derive from it. As far as buy now, pay later, we as a National Credit Reporting Agency, we're ready. We have the platform available to receive that information, and we're working with buy now, pay later financial institutions to start receiving that data. So we're ready to support as soon as the data furnishers start providing that information to us.
Thank you.
So I think this actually kind of acts as a little bit of a segue. We've obviously kind of covered how the average balances, minimum payments are rising. There's obviously a multitude of other factors that maybe these charts aren't showing, that are kind of forcing consumers to kind of require to prioritize their debt obligations. I guess my question to you, Javier, with evolving payment hierarchies still favoring housing, auto expenses, how should lenders really kind of adjust these collection strategies for, maybe product lines like credit cards, unsecured personal loans?
Yeah, we conducted this study with BCG, and we were not surprised. Consumers continue to prioritize their housing, utilities, and autos. And then as you go down into credit cards and personal loans, unfortunately, those get medium to low priority. And you see, Rich, buy now, pay later, and payday loans are at the bottom. And so consumers continue to, prioritize their needs to keep the lights on, to maintain housing for their families and themselves, their transportation needs, and then their mobile phone. That's how we live these days, and we don't foresee any changes to how consumers prioritize. And then also, in light of inflationary pressures, um, you know, uh, consumers are relying more and more on credit cards and personal loans. However, they're prioritizing them lower. Um, and from what I can gather, following the news, interest rates or assistance with interest rates is not in the foreseeable future. I think I heard that rates, may be changed at the end of the year or maybe into the first quarter of next year. So there's been a delay in that forecast. So we will continue to see inflationary pressures having an impact on our wallets and how we choose to, pay off these balances.
Yeah. I mean, Javier, you mentioned that there's been a slight decline in personal loan volume,
Mm-hmm.
right? So that would tell us that the creditors, the lenders are tightening up their risk management a bit.
Yes.
And I think the key term here really is utility, right? That a personal loan, once I get it and I build my deck, other than the enjoyment of my deck, I'm not getting that money back. So
Right.
from a utility perspective, I can't use it again. So that kind of pushes it down when it comes to choosing which one to pay. So it sounds like we are starting to see some pullback from fintech lenders, unsecured personal loan lenders, and seeing some of those volumes come down a bit.
That's right. And for those, fintech lenders and the like, the cost of funds has, has remained high or higher for the last, couple of years. So it's an interesting period. And we'll keep a close eye on interest rates and the unemployment rate and see if there are any changes to this prioritization of payments, over the next couple of years.
Thanks.
Mm-hmm.
Yeah, and as we consider how to adapt collection strategies to these evolving priorities, it's important that we kind of look further how innovations and compliance can shape these approaches. As we kind of start focusing on some of these innovative strategies, it's important to address a significant component of the omnichannel approach, the phone channel. Despite advancements in digital engagement, the phone remains very pivotal in the collections arsenal. Obviously, digital experiences have become outstanding. The call experience often lags behind, with 88% of calls going unanswered. This disconnect can highlight a crucial gap in within customer engagement that needs to be bridged. Furthermore, 87% of enterprises recognize the phone as their most important outbound contact channel, underscoring the need for innovation as to how lenders manage these interactions. And so while these traditional methods remain essential, they must evolve to meet some of the regulatory standards and consumer expectations. In a landscape where robocalls, call spoofing pose significant concerns, understanding and adhering to things like Regulation F is paramount. Rich, in the context of compliance, such as limitations imposed by Regulation F, as that's detailed here on the screen, to help ensure consumer protection against robocalls, call spoofing, what are some key considerations lenders should keep in mind while implementing new collections techniques?
I think a lot of it comes down to the capabilities of their technology platform, because they have to build these rules and strategies that keep them compliant within their platform. Certainly, and this is not legal advice, there's always a view of what regulations actually apply to the actual creditor versus those that apply to third-party agencies. And certainly companies need to seek counsel that are creditors to understand how Reg F may or may not impact them. But once again, if you don't have the right technology to really control these processes, you can easily find yourselves in trouble, right? So I think understanding how effectively, if you're using third-party software, how effectively they are addressing these changes. They have to prepare for Reg F way in advance of it actually rolling out. And I know that it's been a big investment for a lot of third-party software companies. Of course, if you're running on your own in-house platform, the same thing. Do you have everything in place to make sure that your collectors can't inadvertently violate some of these strategies? But I know Javier is going to talk about some of the cool things that they're doing at TransUnion to further help lenders remain compliant.
Yeah, Javier, I know you're kind of chomping at the bit for this next slide here, but just kind of wanted to kind of give you the floor here, kind of talk how some of the tools offered by TransUnion, like caller name optimization, branded call display, have really transformed the call experience. And likewise, I know our next slide, we can kind of provide a little bit of an example of how this has improved some of the contact rates. But again, kind of give you the floor here as to how these have transformed the call experience.
Thank you. Thank you, Matt and Rich. So, nearly 90% of all phone calls go unanswered because, either they're blocked at the carrier level or they come across labeled as or mislabeled as spam or, unknown. Or the worst case scenario is that the caller ID information is from the prior owner of that telephone number. We just completed our financial services customer summit, and speaking to our customers, validated the notion that the phone channel continues to be king. It reigns supreme over other communication channels. And so beyond just collections, right? So when we talk about contactability, we're talking about when our customers are reaching out to establish that first relationship with one of their customers, whether they're processing a loan or servicing a loan or providing customer service or following up on a fraud alert, all the way through to delinquency management. The phone channel continues to be the primary source used by financial institutions, but then it also, remains the most challenging. So our solutions just solve many of those challenges, right? And very simple implementation. For caller name optimization, we simply receive a list of all the phone numbers used by our customer, and we register them with over 800 telephony services providers so that they know that these are valid phone numbers. And then we also work with our customers to set up their branded call so that when the call reaches their consumers, the right information is displayed on the phone device so that contactability rates can be maintained at a very high level. First call resolution in light of all the compliance, headwinds, because this is a very heavily regulated environment, continue to be maintained. So high contactability rates are very important. And then, fraudsters never rest. Spoof calling has been increasing over the years. Fraud is a multi-billion-dollar problem in the financial industry space. And we have solutions that help our customers mitigate those challenges by ensuring, almost like a web browser. Remember, back in the day, it was very easy to clone a website until they developed, HTTP so that to secure that experience. Well, we've done the same thing for the phone channel, so that it is very, very difficult for fraudsters to spoof our customers' phone numbers once they're registered and activated by us.
And I know that we have a bit of a success story here to share as well. If you want to maybe kind of glean some of the major takeaways here, Javier.
That's right. That's right. So our customer was just having difficulty reaching their customers. Um, And in addition to providing them with data hygiene solutions, so they knew which phone number to dial, which phone number scored the highest. We also provided them with a call window. So we on a daily basis we can provide the best 2 hour block for our customers to reach out to their consumers to maximize contactability rates. And it was very well received and implemented by this customer. And as you can see here, for the prime segment, the prime risk segment, we saw a 122% lift. That's not unusual. And then for the non-prime segment, we saw a 60% lift. Now, what's interesting here is for several of our customers, they may not see this level of lift in right party contact or answer rates. But on the right-hand side there, you see the promises to pay rate increase for the prime segment over 135%, and for the non-prime segment, about 28%. Even though some of our customers see a reduction in the answer rates, their promises to pay rates did improve because by having the right branded call information on the phone, it's a reminder to the customer or the end consumer, oh, I need to make a payment. Maybe they're calling me as a reminder to make a payment. Yeah, and also even if they don't pick up, the branded call information is stored on the phone device so that a consumer can then refer back to it at a later time if they decided not to pick up the phone. So very, very good success in the financial services industry. In providing not only data hygiene solutions, right party contact, but contactability, and then also promoting the brand for our customers.
Thank you for that, Javier.
Mhm.
Obviously, kind of shows how targeted strategies can help tackle some of these current challenges, but now want to certainly make sure we shift our focus maybe to the future. Rich, looking ahead, what are maybe some potential innovations, some trends and collections that lenders should be preparing for now? I know you kind of spoke about maybe these upcoming unseen headwinds with student loan payments starting to kind of hit records again. Kind of curious what else folks should be preparing for now.
Yeah, it's interesting. For those that don't know, Javier and I did a podcast at FinTech Meetup a couple months ago, and when we think about collections and innovations, a lot of things are really improving more as a function of the availability of data than the actual techniques. So, going back in time when I was at American Express from 85 to 88, we were using analytics to decide which accounts to work, when to work them. We actually got a file every evening from one of the bureaus of any triggers that would indicate that a consumer with us might be current, but we're starting to see some foreshadowing events. So I think one of the things that Javi and I will get into is that using those same type of techniques that existed for years, I think are just now being more rapidly adopted because of, once again, the availability of better technology, whether you're doing that in a batch or real-time type of capability, and just the huge amounts of data that is out there. If we think about TransUnion had acquired Factor Trust, which was one of the main short-term lending data bureaus. And with that type of information, you're able to get a more holistic view of that consumer because that type of data was not be reporting back into the traditional bureaus. Same thing that we talked about earlier with buy now, pay later, right? So I think, number one, it's going to be more effectively leveraging analytics, which we'll talk about a little more deeply soon. And then, once again, how do you adjust for that prioritization schedule that Javier showed. So if you're a lender where your ranking is more towards the bottom, what are the type of programs you might have to be more aggressive about? And that may be something, for example, like a settlement, or reducing interest, and freezing accounts at a certain delinquency, re-aging, rewarding for performance. If I make, if I'm 90 days past due and I make 4 payments that keep me at 90 days, I might be willing to bring that back depending on what compliance I can do and not do. So I think, overall the techniques are relatively similar to the past. It's really a question of how you leverage such a large amount of data. And of course, now with machine learning, you can be more reactive, even down to almost a customer level of what you want to do more effectively with that customer. But I'll let Javier add to that. I don't want to steal all his thunder.
Yeah. So spot on, Rich. Earlier this week I was with many of my customers, and you're absolutely right. When a consumer goes delinquent, it's not just on one product. It's typically 3, 4, 5. It's credit cards, it's personal loans. They may have an auto loan, and they do prioritize, how they make use of their limited funds. So for a first party collector or even a third party collector, it's a race. It's a race among, there may be, several collection agencies trying to connect with that same consumer, trying to set up that voluntary payment arrangement, which can be enforced, right? And so having insights into the ability and willingness of that consumer to make a payment and stick to that payment arrangement is paramount. Once you understand that information, once you have it in-house, then it's a race to connect with that consumer. And so, we have those solutions that, overcome, those challenges. And then keeping track of that consumer, do they have circumstances that change over time, over the length of that promise to pay plan? So yeah, very important. Data is everywhere. It's probably, some would argue there's too much data, and making sense of it, is a new challenge. Many people are talking about AI and machine learning and large, language models, coming to the rescue, but we'll see. I am attending the CRS conference this week as well, and I'm looking forward to speaking to some of those solutions providers to see what they're coming up with.
Yeah, and I think, one of the things when we touched on the account monitoring, it's that desire to predict more rapidly the problems that are coming up, right? So it's not just thinking about accounts that are currently delinquent, but it's recognizing those accounts that may become delinquent. So we think about behavioral scoring, bringing in data from our own portfolio or the lender's own portfolio, and marrying that with data from TransUnion, and then marrying that with decisioning technology like you can get from GDS's Modelica, right? It's really saying, hey, if I can take all my current accounts, and if I have, let's say, 28 billing cycles, and at each cycle cut, I'm going to do something. I'm going to do a refresh TransUnion report. I'm going to bring in my behavioral data, and I may say, hey, this guy is currently current with us. But, I'm going to move him into a soft touch collections because I see some foreshadowing that's telling me I'm going to have a problem. And to your point, it's a race, right? So if I can get there first, that's going to give me a leg up on some of the creditors who may have products that are over me in that list of prioritization. And of course, the second opportunity for that, especially if we think about those installment loans, where, hey, if this consumer has paid current on a personal loan where he's paid current on 46 out of 48 payments, well, I can kind of get a jump on that and say, hey, I'm going to offer a renewal today because he's showing me or she's showing me that they're consistently making those payments. as far as the data, another thing, Javier, we discussed a little bit at the FinTech meetup was the use of open banking data,
Mm-hmm.
right? And, certainly that needs to be part and is becoming part of that strategy, whether that consumer has permissioned themselves as part of the application process. But I can envision where I'm a lender and I want to offer a settlement, right? And I could say to that consumer, hey, I'm happy to talk to you about a settlement, but you're going to have to permission yourself in so I can look at your banking data so I can get that more holistic view with the goal of I'm not leaving money on the table. I'm about to do a settlement of 30 cents on the dollar when I should really be taking 50 cents on the dollar. So do you see, have any of your clients, talked about the use of open banking data in that respect?
Yes, they have, is the short answer. We also provide verification of income and employment as a solution to help understand the consumer's financial situation, because it does change the talk track, right? If there's a high propensity for that consumer to stick to that payment arrangement, then it's a very worthwhile investment. Now, as we look at signals, our customers are shifting their strategy to more of a proactive approach, right? Because you're right, if financial institutions are waiting for that, first delinquency, they're already behind. Others that are going to be competing for payments from that same consumer. So being proactive, receiving signals, and then reaching out, it makes for a better customer experience. It's better for their brand. It's better for their reputation to be proactive. And there's no shortage of data, no shortage of solutions that financial institutions can tap into to create an environment where a consumer will want to pick up the phone, will want to answer an email, will respond to a letter from that financial institution because they know that they're looking out, for their best interest.
Yeah, one of the sorry, Matt. One of the other latest innovations that I've been reading up on is call center technology that can help measure sentiment.
Mm-hmm.
And it was interesting. I got a demo where it was a mock call, and the consumer calls in. It's a delinquency call, and the consumer says that I was in the hospital and I ran into financial problems, and the collector basically dismisses that and goes right into their pitch. And
Their pitch.
the sentiment technology can highlight those things in training and basically stop that collector and say, why did you not recognize that this person just said they had been in the hospital?
Yeah.
And actually show some empathy.
Sure.
Right. So that technology of measuring sentiment, I think in the call center world is becoming very effective in helping train collectors more effectively.
Right. And more of my customers are updating their self-service portals, right? For that very reason. Good collectors are hard to find, even harder to keep in a tight labor market. And so the better your self-service portal is, right, the better experience your customers will have with your brand. And I'm going to say brand a lot because I heard that word over and over again this week. There's a strong push to ensure that the brand is protected, that the brand is recognized as empathetic, and they're looking to maintain relationships with customers over a longer period of time, as more and more of these financial institutions spread out into newer products.
Really kind of speaking my language, all about the brand there, Javier.
Mm-hmm.
Speaking my love language as a marketer. This has been great, guys. Trying to be a little bit conscious of time. I do feel like we're right back into the podcast episode again here. But at this point, certainly want to hear from our audience and the folks that have joined us today. Again, you're welcome to submit a question in the Q&A via the Q&A button in your Zoom control panel. Also the chat function too, if you have any questions for Rich or Javier. We've already actually had a couple come through, some kind of going back to the beginning of today's presentation. I'll kind of let either one of you take a stab at this, but can you elaborate on the specific types of economic indicators that might be most predictive of delinquency rates in the current volatile market?
Well, I'm not an economist, so I don't know what specific indicators, but I know that internally we have a attribute from our consumer credit database called average excess payment. And that is when, we can measure the amount above the minimum pay that a consumer makes on their accounts. And pre-pandemic, we saw a healthy delta between the min pay amount and above the min pay amount that consumers were making in aggregate on average, and we've seen that amount decrease since 2022. So during the pandemic, consumers deleveraged by using any savings that they had, but that cash is now gone. And so we're seeing a reduction in that excess payment amount to where now it's pretty minimal.
Yeah, I think another thing would be where if you're looking at that consumer's credit report and identifying when that mortgage and or new auto trade line has hit that file, right? Because once again, if they're buying today, they're buying at a far higher rate. That monthly payment is going to be significantly higher, and that's going to put more stress on them if they have any shifts. There's also companies out there that look at one particular I know is called Greenwich.hr, where they kind of look at hiring trends in different parts of the country, and like what salaries are and what the number of jobs that are posted. So depending on where that consumer lives, there's also that impact should they lose their job. You could kind of forecast to some extent how quickly will it take for them to replace, get a new job and replace that income, right? So I think there are some economic data points out there that can be brought into your analytics.
Another question that's come through on the chat, a question about the research that has been done regarding consumers prioritizing certain debts above others. Can you give any insights on what market was targeted to gather that information? Myself and a couple others are operating in the subprime category. Curious how much of this research supports what we might see in the months to come.
Good question. I don't have that answer readily available. I'll go back. I don't remember which tier group was included in that survey.
As you can see, we do have everyone's contact information on the screen now. Feel free to reach out to Rich, myself, or Javier for any sort of follow-ups that we might not be able to cover today. Additional questions that are coming through the Q&A panel, through Q&A button. For the success story, curious on how the use of advanced analytics and data-driven decisioning improve the effectiveness of collection strategies compared to traditional methods. Rich, maybe I might kind of pose that to you. Maybe if you can share a case study or example, or maybe data-driven decisioning has had a significant impact on collections.
Yeah, I mean, I think certainly one of the most expensive resources we have is human capital. And certainly in this job market, it's even getting tougher to find people that want to put that effort forward sometimes. And now, of course, we have a lot more people working from home, too. So the management of staff that's remote in your collection system. So I think, once again, using analytics, Javi and I go way back where the only way to contact a person was really through a phone call or a letter or a statement. And now there's so many different ways that you can contact that customer via text, letter, email, et cetera, et cetera. So number one, using the technology to kind of look historically on, which consumers are responding the best to the different type of treatment strategy. But once again, really leveraging your collectors for probably those more serious talk-offs, if you will, and understanding, which accounts are most likely to self-cure, which ones will be reacting more readily to a soft touch like a text message. Certainly the younger generation, Javier, I don't know what stats you have that might validate this, but I would think that as we age the population, having a phone call becomes more important, whereas we're younger, we really just want to deal with text messaging. So once again, I think using analytics to both determine which accounts you should be working, when you should be working them, and what's the best method to work those people is really what you need to be focused on.
Yeah, exactly right. For a distracted consumer who misses a payment, right? They're going to self-cure using the self-service portal typically. And then you have real work to do after that. You have to understand a consumer's ability and willingness to pay, which requires data and insights, because you only, as a creditor or lender, you only have the information available on your own accounts. But how is that consumer's financial situation with other lenders and creditors? So you need the data. Then you need to be able to then determine what's the best method to communicate with that consumer. And it is important to understand the demographic because, as you said, Rich, the Gen Xers like us will respond to a phone call, right? If we know who's calling, right? But if, I was sitting at a presentation about trusted call solutions, and my phone rang and it said scam likely, and I showed the audience. It was just one of those things. And of course, I didn't answer it. I don't know who it was, and I didn't bother to call them back. But that's the world we live in today. So it's no longer smile and dial. It's no longer a successful strategy to just you know spray spray the customer with unlimited number of calls. You just can't do that anymore. You're going to damage your brand. You're going to just be spinning your wheels, and the cash register will continue to uh, uh, count the uh, less efficient organizations, and hurt their bottom line, unfortunately. So yeah, so data is important, and maximizing your contactability is also paramount.
And another initial question, I think this kind of segues into what you were just speaking on, Javier. But what are some effective strategies for maintaining first contact with borrowers, especially in a market where consumers might be kind of overwhelmed with communication? Personally, it sounds like maybe making sure you do have a strong brand, a brand that's trusted, that maybe is viewed as empathetic, that maybe. But curious, any other insights you might have there?
Yeah, so the information that the consumer provided, when they applied for your product or service may have changed. So maintaining, good information, updated information, data hygiene is very important. And then making sure that you're reaching out to the customer where they want to be contacted. The younger generation, as Rich mentioned, likes texting. They may respond to an email. But, some consumers, will never pick up the phone, no matter, what you do. So you have to meet the customer where they want to be met. And then, give them options on how to communicate back to you. You have to give them options on, how they can, self-service. And in the current environment where it's a very tight labor market, and good collectors, good staff, they're getting harder to maintain. They're becoming more expensive. It's important to give your staff the right tools, to make them successful and, and enjoy the process. Because it's not fun calling folks that are delinquents, but it needs to be done.
Thank you for that, Javier. We've obviously covered quite a lot today and want to thank everyone for the engaging questions and the lively discussion during the Q&A session. Now, as we wrap up, just want to highlight some exciting opportunities to help kind of continue these conversations, help deepen everyone's understanding of the topics that we've covered today. First, for those eager to dive deeper into the world of credit risk and lending, be sure to check out and subscribe to the Lending Link podcast. You might have heard that Rich and Javier already had a discussion that we recorded live at FinTech Meetup in Las Vegas. That's one of the multiple episodes that include various industry experts discussing critical issues that are facing financial service organizations today. You can listen and subscribe on Spotify, Apple Podcasts, Google Podcasts, and all major streaming platforms to stay updated with the latest insights. Next, we are thrilled to announce the upcoming release of a new ebook developed in collaboration with TransUnion titled Navigating the New Era of Collections. This guide will be packed with additional digital strategies and insights vital for today's lenders, especially as we navigate these unprecedented times. That extends this conversation we started today and offers some actionable strategies for modern collection techniques. Additionally, we invite you to explore Seizing Opportunity in Uncertain Times, a comprehensive market report from TransUnion. I know that we kind of touched on some of the insights from that report today, but this report explores how the economic uncertainties and evolving debt landscape are shaping collection opportunities and challenges, while also touching on the impact of AI and machine learning on these efforts. A link to download this report will be provided in our follow-up to all the attendees today. Additionally, we will be sharing a replay of today's webinar along with this slide deck by the end of the week. We invite you to revisit and share with colleagues as you see fit. Want to thank everyone again for joining us today. Special thanks to Javier and Rich for their invaluable contributions. We hope today's session has been enlightening and that you leave with some new ideas and strategies to implement. Other than that, we hope you have a great day and look forward to seeing you at our next event. Thank you all.
Thank you. Talk soon.
Talk soon. Thanks, Javier.